comes from our friends at housingwire.com. Again, an industry resource. You know, this is definitely a well-read site for not only real estate people, but mortgage lenders and others in this neighborhood, this community, this industry. So let me go ahead and get into it, Darren. And this is really a reappraisal, it seems, of earlier predictions from CoreLogic. So basically, Selma Hepp gives an updated look at her forecast for the year. While housing trends in the first quarter of 2022 resembled the previous year's trend, buyer frenzy, homes selling over the asking price, and continued home price appreciation, much has changed in the spring, which will impact some of the previously forecasted scenarios. So let me go through here. Oh, I need to sign in. I forgot. Let's see. Just bear with me, Darren.
Right, and this article was written in early May. It talks about a couple interest rate hikes that are being predicted, and we recently encountered another one of those, which is having an impact on the market. So it's talking about how that and other elements are, adjusting the expectations for the second half of the year. It's a great article, and the timing is very good.
Okay. All right. Well, I'm back in. So deviations from economic predictions. Most significantly, the Federal Reserve evolved from a gradual removal of monetary accommodations in 2022 to an aggressive forward guidance on how it plans to reel in stubbornly elevated inflation measures. Currently, bets are on 50 basis point hikes in May and June meetings. Now, as we talked earlier, Darren, one of those has already happened. Back May 4th. So don't panic, everyone. Followed by 25 basis point increases through the end of the year. Similarly, balance sheet runoff is also likely to take a more aggressive timeline than initially anticipated. As a result, markets were quick to respond, driving mortgage spreads and rates much higher than most experts expected by this time of year. At over 5%, mortgage rates are now the highest they have been since 2010. Looking ahead, the outlook for mortgage rates and the larger economy is uncertain, particularly as we consider the ongoing conflict in Ukraine, its rippling effect on the world economy, and the faster removal of monetary accommodation. Mortgage rates should hover around 5%, but there may be more oscillation than we have seen recently. Any comments there, Darren?
What might seem obvious, but Ukraine is having, worldwide economic shifts. So what continues to happen there is certainly one of the biggest variables right now going forward.
Yeah. I know. I forget the exact amount. I want to say it's like 22 million tons, some crazy amount of wheat that's just sitting in Ukraine. And they're a huge supplier of wheat to the world. So that's just one instance. All right. So the impact on housing markets. As a result of surging mortgage rates and more aggressive tactics from the Fed, buyers flocked to the housing market during the early months of the year, pulling spring home buying demand forward. However, inventory of for-sale homes continued to lag in prior years. And despite posting some seasonal increase, barely offered relief for frantic home buyers. Home buyer competition and bidding was peaked again, and the share of homes that sold over the asking price reached last summer's high, with 6 in 10 homes selling over the asking price in March. And as I told you, Darren, we'll see that later on when we get into the solds from the last week. Though widely anticipated, the inventory of for-sale homes, unfortunately, does not look promising for 2022, particularly given the surge in mortgage rates and the general sense of being locked in by existing homeowners. While we may see some increase in new listings in out-migration markets, such as those in Northeast and northern areas of the Midwest, markets that have experienced strong buyer demand, such as Mountain West and Sand states, are not likely to experience a similar relief. While surging interest rates and lack of inventory are expected to have a dampening effect on demand, there are still many buyers who can afford the rising costs of homeownership and hence will compete for limited properties. Additionally, after a decline at the end of 2021, we continue to see elevated levels of investor activity in 2022. In March, investors made up 28% of single-family home purchases. Motivated by the continued rise in single-family rents, investors were likely snapping up these homes to turn them into rentals. The CoreLogic single-family rent index increased to yet another high at the beginning of 2022 and registered a 13.1% annual increase in February. Comments there, Darren?
Oh boy.
You're right. I know.
The simple component of rents rising with the cost of housing rising just makes sense. I mean, no one can dispute that. And, we're going to talk about our specific local market in Los Angeles, who has had a rent freeze for 2 years and will have it at least for another year.
Right. How many of those mom and pops can hold out for that?
Believe it or not, it's the whole issue of debating rent control. It probably is driving the prices up of the available houses even further, artificially substantiating the lower cost for some people.
Mm-hmm.
And you're already hearing outcries about, ending eviction moratoriums and other elements as well. You'll hear them until it ends, period.
You're right. Well, the thing that got me here, and I know you've been on this wagon, is the investor side being 28% of the sales, the purchases, and what controls are on those investors in the market.
My phone just rang and I can hear you amazingly good now. I have no idea why, but it's fantastic.
Hallelujah. Hallelujah. All right. But I don't know what you heard. Did you hear what I said?
I did. Investors being 28% of the purchases.
Yeah.
It's, my friends in the real estate industry won't like my comment on that. And that is that the real subsidy will be, rather than a rent freeze or an eviction moratorium, there could be a moratorium on investor purchases of single family homes.
Yeah.
That would, and I think they should have done that at the beginning of the pandemic. And that would have a much larger impact. So, that would have an impact in leveling off houses, increasing supply. Because as this article says, that's obscene with the price of houses going up as much as they are. That means 30% of the market is consuming that for profit. And that means the other 70% of the market is some suffering going on, and they're paying a lot more to live.
Right. Whether renting or buying. Yeah. They're covering off on both.
I personally believe either extremes. My whole conversation for many years has been, I enjoy the middle. Pure capitalism is awful. Pure socialism is awful. There are good components of both.
Yep.
And this is capitalism, in my opinion, going too far. They need to scale that back a little bit, and maybe it'll have an impact.
Okay. All right. So market considerations. Given the competing demand and historically low supplies, home price growth, which gained more steam in 2022, is likely to remain robust and continue to clock in at double-digit rate of growth through the remainder of the year. The CoreLogic Home Price Index forecast is now predicting the annual average rise in the national index to be 17% in 2022, up from 15% in 2021. On the other hand, re-acceleration in home price growth, coupled with higher mortgage rates, will take a bite out of the home sales activity. The previous forecast of a 1% rise in home sales for 2022 has been revised to a 3% decline. Cash out refinancing. Home mortgage rates will also continue to impact refinance originations. Again, with much higher mortgage rates than previously expected for the year, refinance origination volume is likely to have a notable decline, possibly by more than 70% compared to 2021. Wow.
Yeah, and they were scaling back last year knowing this was coming.
Yeah.
The huge layoffs in the mortgage industry.
Yep, still happening. Refinance incentive has been largely removed with rates above 5%, given that 90% of current outstanding mortgages have a rate that is less than or equal to 5%. Nevertheless, the share of borrowers who are looking to cash out will continue to increase. This is due to homeowners tapping into the record amount of home equity wealth they've accumulated during the recent years of double-digit home price growth. The cash out share of total origination dollar volume has already reached the highest level since the late 1990s. Wow. With the latest March 2022 reading at 22%. At the 2004 pre-Great Recession peak, the cash out share of volume originations reached 17.7%. As we've noticed before, refinance borrowers will likely have slightly lower average credit scores as borrowers with Federal Housing Administration loans refinance into conventional loans with a loan-to-value ratio of 80% or less to eliminate the mortgage insurance premium.
Couple components on that, I'll say.
Mm-hmm.
So, as you know, Joe, I've been doing this for 20 years, and I lived through the bubble back in 06, 07. And that was about people fully extending their whatever they could on the loan, and that 100% and more of the purchase price. That was crazy.
Wow.
Those were absolutely bound to go into foreclosure. This isn't that, but I will say this: we've had an uptick in pricing for 13 years now. I believe it really started in maybe 2010, so maybe 12 years.
Yeah.
And when people all of a sudden they have a ton of money, they do cash out. I just hope they're a little conservative on those cash outs. My advice to any of you who are listening: yeah, no problem. Take some money out, feel good, do some repairs. Don't push all the way to the max, man, because
Give
then you
some
just
room.
leave yourself some room. It just leaves you at risk. Eventually, we will have a turn in the economy, and to be maxed out during that time puts you further at risk. And nobody wants to see people losing their homes. I don't. Maybe the investors do. That's the only class of people that might be interested in that dynamic.
Right.
But so be a little conservative. We've had a long uptick. So be conservative, keep some money, keep some equity in there. It'll give you some leverage in the future. And if you have to sell, you'll have equity to sell.
Yeah. All right. Additionally, these borrowers will also have a longer average loan term to keep the monthly payment low. The availability of home equity wealth will also likely lead to an increase in home equity line of credit loans, which will allow owners to borrow against the available equity in their home without giving up the low mortgage rate. Employment and income. Lastly, strong employment and income growth have helped to keep new delinquencies at a very low level. The 30-day delinquency rate remains at its lowest in a generation, while foreclosure rates have ticked up slightly in January as foreclosure moratoria and the CARES Act forbearance program ended. Nevertheless, at 0.24%, the foreclosure rate remains at half of the average rate seen in a decade prior to the Great Recession. The areas that may see an uptick in distressed activity are along the Gulf Coast and some parts of the Northeast. The road ahead. Taken together, 2022 will still be a strong year for housing, albeit more challenging than previously anticipated, particularly for potential buyers who aren't able to afford the increase in monthly mortgage expenditure due to higher mortgage rates and home prices. So summary of predictions are: number one, interest rate on 30-year fixed rate loans is projected to average 5% through the rest of 2022. Number two, home sales to decline in 2022 from 2021's 16-year high. Number three, single family home price growth to remain robust, averaging 17% for the year. Number four, less refinance loans, but with a larger cash out share and more HELOCs. And then number five, loan delinquency remains low, but with some uptick in distressed sales. So there you go.
Be careful on those HELOCs. For those of you considering HELOCs, if based on the tax code that was adjusted, I believe it was 2017, unless you put that money back into your house, it might not be tax deductible as it was in the past. So always check with your accountant prior to initiating a HELOC.
Got it. The number that has stuck me twice is single family home price growth to remain robust, averaging 17% for the year. That's a national average. So yeah, what does that mean for LA and other, you know, upper end areas?
Right.
That's
think
incredibly far higher.
I assume what will happen is some of the smaller areas will consume more of that. I think we still have a shift to secondary markets. That trend, I haven't heard anything to the contrary as far as what it will continue, which means that those areas might see higher growth. Like I was speaking with someone today, they were talking about, well, yeah, people are now thinking about leaving Austin, right?
Yeah,
Because the price has gone up so much, exponentially, even
right.
greater than LA.
Was
And
that
those are
Jason? Who
our
was it?
liberal friends. No, to actually
Yeah.
leave the state because
Oh,
forgive me for expressing political perceptions, but there's narrow pockets of Texas where some people may want to live.
yeah.
Um,
Yep.
so yeah, they're like, great, I'm going to take all this profit, and now it's as expensive as other areas, so maybe it's time to move on. So there's just going to be, I think there's going to be people finding right places that are outside of the big cities. I mean, I've said it multiple times. If I was buying my first house and if you can't find something and you really want home ownership and you see no path to home ownership, then you leave.
Yeah.
You have a choice, staying in the city and being a renter
Right.
or leaving and buying somewhere else.
Yeah.
It's
Go
stability, it's
find it.
growth, it's
Yeah.
financial, huge. Buying a house is huge. So people are
Yeah.
going to continue to leave.
Yep.
But
Yep.
we'll have people coming in from international places, from people with more wealth, people from more expensive cities coming here, as we've seen consistently. It's just the people who can't buy here may end up leaving.
Got it. Okay. All right. So that's that on 5 predictions.